The 2023 car market collapse, which nobody could have foreseen just a few years ago, is now escalating beyond anyone's expectations. This situation is causing turmoil not only in the used car market, which is spiraling downward, but also for automakers who are grappling with destructions in new car production. The result? Tightening inventory that could further inflate prices in the coming months. This crisis has raised alarms on Wall Street, with major banks like JP Morgan and Morgan Stanley warning that it could have dire consequences for the economy and financial markets this fall. Now let's delve into how this crisis might affect American consumers in the months ahead. But before we do, make sure you stick with us until the end of this video for the full picture. And please make sure to subscribe to the channel and leave a like below this video. We appreciate all the support. September has proven to be a challenging month for car dealers and automakers alike. Despite months of progress in production levels, manufacturers are now compelled to slow down as new car sales stagnate. Some car companies are also facing supply chain issues, and this is already impacting their financial performance. Earlier this month, Hyundai Motor North America's CEO, Jose Muna, expressed his disappointment, saying that slowing growth has pushed the Korean brand to the brink. "We are in crisis mode," he stressed. August data further highlighted the industry's downturn. While consumer prices for new cars showed a modest 0.3% increase, compared to nearly 4 percentage points a year ago, it suggests that new car prices might be hitting a temporary ceiling. On the flip side, the used car market witnessed its most significant August price drop in over a decade, with a 6.6% decrease. However, experts at Cox Automotive believe used car prices haven't hit rock bottom yet. Used cars are now taking longer to sell, with some popular models sitting on dealership lots for 29% longer on average. For instance, a used Tesla model now takes an average of 88 days to sell, with prices plummeting from $69,877 to $65,625 since January. Ford's Mustang Mach-E has seen a similar fate, dropping from $44,250 to $29,500 and taking 76 days to sell. The price changes are substantial for car buyers, particularly with rising interest rates making auto loans more costly. On the other hand, car dealers are feeling the pinch as demand cools down. Initially, used car prices surged due to a lack of new car inventory. But now, even though there are plenty of new cars on dealer lots, consumers aren't rushing to buy them. Now, here's the twist in the story. The new car market is facing a different set of challenges. A strike initiated by the United Auto Workers Union, UAW, against Detroit's big three automakers, General Motors, Ford, and Stellantis, has thrown the new car segment into turmoil. This marks the first ever simultaneous strike by the UAW across all three automakers, with over 12,000 workers demanding better pay and benefits. The implications of this strike on the already fragile car market are significant, and we'll be keeping a close eye on how it unfolds. So don't go anywhere, as we'll be updating you on the latest developments in the coming weeks. Insiders are deeply concerned about the ongoing auto worker strike, and if an agreement isn't reached by the end of this week, it could quickly escalate in terms of both participants and locations. The gravity of the situation cannot be understated, considering that General Motors, Ford, and Stellantis collectively account for approximately 43% of new cars sold in the US. In simpler terms, this supply chain destruction is poised to reach massive proportions. Michael Fye, the chief US economist at JP Morgan, is sounding the alarm. He warns that a prolonged nationwide strike could severely hamper production and lead to inventory shortages, potentially causing a significant increase in new car prices. Rob Hamfield, a Bank of America University professor of supply chain management, estimates that a month-long strike could result in roughly a 10% price increase for affected vehicle models. If it stretches on for 2 months, we might see dealerships with empty lots, and prices for available inventory could skyrocket. While it's still uncertain how long the strike will persist and which auto plants will be affected, consumers are already feeling jittery about how these work stoppages will impact their ability to purchase a new or used vehicle, or even maintain their existing ones. Tom Mioli, a Ford dealership owner in New Jersey, points out that parts availability will be a significant concern. This includes essential components like tires and brakes needed to keep vehicles running smoothly. The labor strife also has the potential to send shockwaves through the US economy. analysts warn that a substantial wage settlement, such as the UAW's demand for a 40% increase over 4 years, could trigger inflation across various industries, which would eventually affect consumers. This scenario is poised to add a new layer to the already complex inflation situation. Morgan Stanley's Alan Zettler estimates that higher prices for new vehicles could contribute as much as 2 percentage points to the monthly consumer price index, considering that the transportation group accounts for around 16% of the CPI. The combination of surging new car prices, dwindling inventories, and a significant wage settlement could swiftly reverse recent declines in inflation numbers. What complicates matters further is that Morgan Stanley economists suggest that this could lead to a contraction in GDP by nearly 1 full percentage point in the fourth quarter. With oil prices on the rise and the specter of $100 per barrel looming, the last thing anyone wants is another inflation catalyst. Over the past month, crude oil futures have surged by 30%, indicating that oil is once again contributing to inflation, not deflation. Gasoline prices have followed suit, reaching $3.98 per gallon in the third week of August, according to data from the U.S. Energy Information Administration. This is a nightmarish scenario for Federal Reserve policymakers. They will need to raise interest rates for longer than initially predicted to achieve their goal of 2% inflation. What makes this situation even more precarious is that financial markets are hanging by a thread. This puts investors, companies, and banks at risk, particularly due to their exposure to auto loans. As interest rates rise, the number of auto loan delinquencies and defaults increases. For years, Wall Street has profited from subprime auto loans. Investors eagerly bought bonds backed by auto loans because they historically delivered attractive returns even in bear markets and economic downturns. As a result, since 2020, the nation's auto loan balance has surged by 28%, now exceeding $1.5 trillion, making it the fastest growing type of consumer debt in the US, according to data from the Federal Reserve Bank of St. Louis. Since 2018, auto bonds have also seen significant growth, as lenders bundled these loans and sold them as securities on Wall Street, often labeled as safe investments by rating agencies. A partner at Davis & Gilbert in New York, specializing in finance and corporate insolvency, pointed out that investors and lenders seem to have unwavering confidence in their protection. However, for the first time in nearly 2 decades, this winning streak appears to be coming to an end. Several prominent used auto lenders are now facing either a surge of defaulted loans or increasing regulatory scrutiny. The Consumer Financial Protection Bureau is currently taking legal action against multiple lenders over potentially predatory practices. The first major red flag emerged in late February when American Car Center, which provided loans to customers with challenging credit histories, abruptly closed its 40 dealerships across the southern United States and filed for bankruptcy protection. A few months later, another lender, US Auto Sales, also collapsed, leading to the closure of dozens of dealerships in multiple states. Fast forward to today, and the rates of delinquent and defaulted loans are skyrocketing. Rating agencies have revealed that the number of subprime borrowers who are behind on their auto loan payments by 60 days or more is at its highest since at least 2017. This troubling trend is exacerbated by the end of pandemic aid programs and the Federal Reserve's decision to raise interest rates 11 times since March 2022. More and more Americans are struggling to meet the demands of their expensive loans, raising the specter of mass defaults that could trigger a sudden meltdown in the US financial system. It's worth noting that earlier this year, Elon Musk warned his Twitter followers that the auto loan crisis could lead to the worst financial crisis ever. At the time, the media dismissed his statement, asserting that the two sectors weren't directly linked. However, as events have unfolded, the connection has become clear. A historic car market crash is already underway, and it's becoming increasingly evident for anyone paying attention. Thank you all so much for watching. Please make sure to leave a like below the video and comment your thoughts below. See you soon.